The U.S. Federal Reserve, which begins its two-day policy meet tonight, and analysts are expecting the Fed to extend its Operation Twist to keep interest rates low and boost growth in the U.S. economy. Alternatively, Ben Bernanke may even announce a third round of easing measures different from Operation Twist. Whatever the measure, the markets are hoping that the Fed will indulge them this time around. Analysts will also keep an eye on the central bank's assessment of the Eurozone crisis and its impact on the U.S. economy. For more on the expectations from the U.S. Federal Reserve, we've got Douglas Blake, who's wealth manager with Newbridge Securities Corporation, joining us on the phone line from New York. Douglas, the big question on every investor's mind across the world possibly is, will they or won't they? What do you think?
Well, for now, I'm going to have to err on the side of won't they, and I'm taking that stance for a couple of reasons. Let's start with the Fed's dual mandate, which is price stability and maximum employment. And while they have price stability, and in fact, probably the grounds for more easing on that side of the coin, they also have the issue of maximum employment, which is on the table because employment here in the U.S. is certainly not at its maximum, and the job growth is showing signs of deceleration. However, despite the fact that both of these are working in the favor of the Fed, I think that, number one, towards the end of QE2, we started to see signs that, in fact, that strategy was not working. We saw inflation only in areas like gold and commodities, and we didn't see any more progress in the jobs market. We certainly, didn't see things one way or the other in terms of price movement. Now, on the other hand, Operation Twist, something set to expire at the end of June, they could very easily continue with because, frankly, this is not increasing the size of the Fed's balance sheet. It's merely selling short-term treasuries, buying long-term treasuries, trying to flatten out that yield curve and stimulate the economy that way. So that's something, let's call it OT2, that is definitely on the table. But I think with all of the uncertainty in Europe, and this really being, the potential for another financial crisis, I think you're seeing both the Fed and the PBOC in China kind of drag their feet on doing anything dramatic just yet so that they have options down the road should things worsen dramatically over in Europe.
Right, so Douglas, would you then say that QE2 was a failure and that if we do see QE3, it's going to do us more harm than good?
Well, at this stage, because we have these issues in the global macro picture, QE3 would not be a very precise tool for resolving the issues that are out there in the economy. As far as QE2, it's hard to say because I can't tell you what would have happened had we not done QE2. But it's clear that, the very dramatic actions taken by the Fed in the past 2.5, 3 years to lever up their balance sheet and support the economy have worked to an extent. We've been able to see ourselves swoon out of this financial crisis. It's not really for me to say at this point whether they could have done a little more or a little less. But going forward, I think what we saw towards the end of QE2 was that the market was not responding in the way that the Fed was hoping towards the end. We didn't get this rampant growth in GDP. In fact, that's starting to decelerate. We certainly didn't get sustainable growth in the jobs market, although the progress continues. That's starting to decelerate. And I think at this point, and Chairman Bernanke really alluded to this, it comes down to Washington, resolving the tax issues, with what we're calling tax Mageddon towards the end of the year. How about passing a budget for the first time in several years? Figuring out ways to mitigate the risks of a fiscal cliff where we have to dramatically cut spending in the next year or two. That uncertainty is plaguing these markets, and that's not something that the Fed has the power to or the mandate to do anything about. So I think going forward, the resolution may have to come from other areas of Washington and not just from Chairman Bernanke.